Okay, so this needs to remain open. Okay, so I'll just show you what has to be done when we come to this. If we take, so here's what you should do. When you get that YouTube link, every day you'll get a YouTube link, okay? So what you do is you just take any spreadsheet and you organize your classes in this manner. You just place the link. I'll just show you here what you see on this spreadsheet here. You can do the same thing for yourself. Like these are all the classes, right? So today you can just copy it from the YouTube video name. From the YouTube video name, you can just copy the name, and against that I've got that hyperlink, okay? So that link which comes for that particular day, this will be the hyperlink. If you click this, then that class will open. Has everyone followed what I'm saying?
Sir, it shows video.
YouTube link doesn't work.
Video unavailable.
Okay, fine. I'll just have to keep sending the second link. Okay. So you can do that, but
the objective now is.
So Tanuja's question still applies, and you can make your life a little easier if you arrange it in a spreadsheet like this. I will keep sending the link. So every day you get a link for that particular day's class. Just organize it in columns. Okay. Keep the name of the class and the date, because I'm giving you the date as well, as you can see here. The date is given to you, all right? And then against that you place the hyperlink, so that later on when you want to study, you can study a little bit easier. You can just access instead of having to go and dig through your email. Are you following what I'm saying?
That's the problem.
Is this clear? Okay, so I'll keep sending you. The links then. I don't know why the YouTube link is not working. They say that it's supposed to work. Okay, all right, guys. Let's start with. We have covered most of the stuff, but let's just make sure that we've got everything here covered. Then we'll move on to the next note. Is that too much?
That's not told how to open it.
The YouTube link. What is it?
So you have to log in from the DSP account.
Oh yeah, obviously.
YouTube page.
1 minute. Okay, so that is so obvious, guys. 1 minute.
Sir, for YouTube.
You are logged in through YouTube DSB and still not opening.
Sir, some people are logged into their respective Gmail ID.
No. Your Gmail ID is not going to work. I am sharing you one sec, guys. Let's understand. Let's learn a little bit about YouTube video sharing as well. Okay. So I have shared this as a private video. So it is only available to those email addresses. So I have given it to the 58 email addresses of the whole class. So if you are not logged in through your DSB ID, that goes without saying. You will not be able to log. So please test it. Okay. So that means I'm going back. So Dina, are you sure about that? You're logged in through your DSB ID and you're still not able to access? Check it now. Just be checked. So then in that case, we go back to the old test. Gatekeeper is certified. Okay. All right. So we are going to go back to the old experiment. I'm not going to send you a link today. You log in through your DSB account and then check it. That's how it should be. Okay. No. 1 minute. We must avoid redundant activities. Don't be lazy, you need to learn all these things, okay? Need to make sure that you know how to access it from that. You've got the link, okay? And whenever you click that link, YouTube will check whether your email ID, so you need to be logged into your DSB ID, that is understood, okay? Alright guys, let's quickly go through this. It's working. So that's fine. That means there's no problem at all. Okay. So I hadn't even thought about this. It's so obvious. Obviously, you have to be logged in through your DSB. Everything, none of this stuff, notes and all that stuff, you're not going to get. Okay. And I still keep getting mails from people with their Gmail IDs. They want access to the notes. I'm only giving you access to the DSB ID. Okay. So you have to have that much discipline that when you're studying, you're going to be logged into your DSB ID, which you should be anyway logged in because you don't know when a new announcement might come. Okay, let's quickly go through this note and make sure. I don't know why this stuff is not. There seems to be a display problem. Then we have to make it even smaller than this. Okay, but you can still read it. Oh, I have to first tell you the right answers, okay? So anyway, let's get to the, okay, we're already here. Let's get down to the place where we're going to start, and then okay, so we'll start from here. I'll just do the coverage of the CP questions. So I'll start with question number 10. Sorry, not question number 10, but question number 9. Okay? Very easy, straight from your notes. I don't know where all this stuff, and many of you said financial risk. I have still given you the marks for that, although the right word actually financial is not the same as financing. But I've been very lenient and I've given you full marks for that if you mentioned financial, okay? So these are the categories of risk. I don't know where all your stuff like war and this stuff is coming, okay? So these are the categories of risk, okay? Nobody got legal and regulatory, credit risk, nobody got all that stuff. I think Ishan got the highest number of those risks, okay?
Is this a broad category or more categories can come under this?
No, see, remember what we discussed when we discussed taxonomy? Did I discuss this question that you must have kind of, you know, more or less mutually, you must have mutually exclusive categories. Okay, the word taxonomy, these are called taxa. In this case, you have 5 taxa. Okay, now the taxa should be mutually exclusive. You understand what is meant by mutually exclusive? Okay, so therefore you can't have. Did I discuss this example with you that you can't have a taxonomy where the categories are like, let's say, Germans, Japanese, dentists, and plumbers? Is this a good taxonomy? If I classify a bunch of people in a room, if I classify them into Germans, Japanese, dentists, and plumbers, is this a good taxonomy? What is the problem with it?
Because one is with respect to the country, nationality, and one with respect to the profession.
That's fine, okay, that I understand, but there's a bigger problem. What is the other big problem here?
All people can't be included.
Sorry? Yeah, so the other problem is that the dentist could be Japanese. So you don't have a mutually exclusive categorization. That's why I have, did I discuss with you that sometimes you see in your textbooks categories like, you see that asset classes are defined as equities, debt, futures, and options. You'll actually find this in your first textbook, in your IPM textbook. Equities, debt, futures, and options. So this is not again a good classification because you can have futures and options on equities and futures and options on debt as well. So this is not a good classification, okay? So that's why when you do categorization, when you do a taxonomy is a very important subject. Actually, unfortunately, it is not officially covered in any business school because this is one of the things that you have to do when you go out into the business world, okay? You've heard this discussion that the problems you face in the business world are unstructured.
Yes.
You had this discussion, that's why you do case studies, okay, which are quite unstructured, and then you learn frameworks, okay? So it's very important to have a good understanding of how to do a taxonomy, because when you see a complex situation, the way you bring structure to that situation is by doing very often you might have to do a taxonomy on your own, okay? Categorizing the thing. So it's very important to know how to do it. What is the correct way to do it? So coming back, long answer to your question, the taxa should be mutually exclusive. Now you're talking about more categories, okay? So yes, you can have more categories, but at the high level, okay, this is the highest level. Now I've told you about a second level as well, okay? Because taxonomy, remember, is always like at multiple levels. If you look at my, I'll give you an example. So what do I mean by taxonomy? Look at this. Just follow the, okay, can you see different levels?
Yes.
So under WIPS, I've got DSB, I've got academics as one category. Then there is administration, and each of the semesters have a certain category. Now in certain semesters, I might have taught 2 courses. Yeah, so look at that. Can you see that? Can you see all these different levels?
Yes.
Okay, so this is how you do a taxonomy, okay? So when you're talking, when Tanuj is talking, it's a little slow. So I wanted to give you the full picture. So you see academics is the first level. So it's like a tree branch structure, okay? This is very important to understand how to do a proper taxonomy because it will help you in the real world. You must know how to do it properly. So Tanuj,
Yes, sir.
answer to your question is, there can be more categories, but they have to be at different levels, lower levels in the tree. That is the high level I've given you. Now you see under July 2017, sub-classifications, subcategories, okay? So you can see under July 2017, there are two different courses. So there are two different subfolders. Again, underneath that, you can see all that. Has everyone got the sense of this?
Yes.
Everybody's busy looking at their phones. Has everyone got a sense of this? Taxonomy is a very important thing to remember. I mean, that's why first thing is, your high level categories should be as few as possible ideally, and they should be mutually exclusive. Okay, you can have, where you have flexibility is, you see how many levels I have in the tree. Can you see that? From starting from DSB, WIPs, then academics, then under each semester, then I have first under each course. So there are many levels in the tree. So when you're doing a taxonomy, then you can actually, give yourself enough room in terms of levels in the tree. But at each level, the categories should be as broad as possible and mutually exclusive, and as few as possible. Okay. So your answer is, if you go back to our, I'm just coming to you, Goel, 1 second. Your answer is, if you go back to our definition of, what did I say? Did I discuss something? Did I further subdivide any particular category of risk here when we had the discussion? What? You guys remember or not? When we had the discussion about all these different categories of risk, did I further expand?
Operating, you said under political under operating.
No, I didn't put political under operating. There is another, there is one category here that I further expanded. I showed you how to further expand it. What is that? You've forgotten all that. 1 minute. Did I not say that? Asset classes are not coming through. Okay. Okay, you know the framework, but I'll just save time and go back. Did I not show you everybody is completely blanked out on this? Did I not say that market risk, when you're examining market risk, you will further go back to the asset classes, markets and instruments framework?
Yes.
And then you will further examine market risk by subcategorizing it into different asset classes first. So when you're doing a market risk report on a particular, on any trading book or any investment bank or whatever, you're analyzing the market risk of an entity. You will classify the market risk into, like we did the exercise with respect to. Did we not do this exercise? Okay, so everybody is blanked out. We did this exercise. We said that if you are preparing a risk report for the board, you will first categorize the different high-level risks: market risk, credit risk, operational risk, and then when you are doing a further detailed analysis of market risk, you have to go asset class by asset class. So then you will first pick on commodities, and then you'll say, okay, in commodities, and then you're going by market and by instrument. So you will have to bring in, when you're doing a detailed analysis of market risk, you will have to bring back that asset classes, markets framework, instruments framework, and further discuss market risk in detail going by each asset class. Okay, so commodities, you have 3 of them, currencies, you have 2 of them, interest rates also you have 1, in debt you have 1. This is clear?
Yes.
So Tanuj's answer to your question is, there are more categories, but they will be as subcategories. So now it's amazing that everybody is blanked out on this discussion that we had. That is because most of these people are not, most of you guys are actually just focusing on your phones. First row, there's a competition from all the way from Ayush to Jayant, all looking down at their phones. Maybe they're playing some computer game. You're playing some computer game? Okay. Everybody's hunched over their mobile phones. Okay. Alright, okay, now Goel, what was your question on risks?
Then why can't we consider economic and political risk as a broad category? Because if there is a trade deficit in the country or rupee is depreciating.
1 minute. Okay, I think it's on the same tab. See, economic and political risk is considered sometimes, but it's very hard to see. Most of these you can identify. So if you're talking about economic and political, economic risk is already captured in market risk and credit risk. So you don't need a separate category for economic risk. If the economy tanks, okay, if the economy tanks, then it will get reflected in your market risk and your credit
What
risk.
I feel is that market risk and credit risk should be covered under the economic risk instead we are saying.
Okay, you could make that argument, but this is normally not how it's done. Okay,
So I have read in many books. So
yeah, but you can do that. But normally, when you're doing risk analysis at a firm level, we look at this is meant to do risk analysis at a firm level. Okay, those are not sufficiently specific, and so you can make that case that you have market risk can be economic risk can be further subdivided into market risk and credit risk. You can make that argument.
It is also subjective. It may be different.
No, but in terms of general risk balance, okay, I've told you in terms of what I'm also teaching you is how the market discusses it, okay? So in general risk balance, the only difference that you'll see is that the financing risk might be discussed as liquidity risk. The financing risk aspect might be discussed as liquidity risk, but I've called it financing risk because I think it's a more illustrative term. It illustrates the risk better, okay? But market risk and credit risk are the major categories of risk when you're doing risk analysis, okay? If you do a further certification in your risk certifications like Global Association of Risk Professionals, GARP, okay, FRM. If you do FRM, then you'll see that these are the kind of categories that are discussed, okay? All right, yeah, okay. So this is a question that many of you did not answer properly, okay?
Why that's
Yes.
Someone has no.
Yeah. Please keep a watch. Okay. All right, guys. Next question quickly. Okay. So intermarket spread. Okay. One example. Many of you answered this in a very sloppy way. Just saying that I've answered. Something. Just didn't mention long, short. Okay. You have to mention. Obviously, if you have a spread position, the sign of the position on each of the markets will be opposite to each other. Some of you just mentioned down long crude oil, long jet fuel. That's not a spread position, okay? Those are two outright positions. If you're long crude oil, then you should be short jet fuel, or vice versa. So many of you were very sloppy in answering this question. Intermarket spread would be short. You could just take the example that we discussed in the class of an airline. You're short jet fuel and long crude oil. Okay, so that's an intermarket spread. Intramarket spread, again, many of you answered this in a slightly sloppy way because many of you talked about the maturity as you don't have futures contracts which are running from Jan to March or whatever. Okay, the futures contract is always defined by the delivery month. Okay, so you have to say that I'm short. In the case of intramarket spread, you can say I'm short soybeans for January and long soybeans for October. Okay, that's the example. The Ishan answered this correctly, actually, if I remember right. Okay, so that's how you have to. So futures contracts you don't mention in terms of running from January to October. Okay, you have to mention it as short soybeans for January, long soybeans for October, and so on and so forth. 1 month only. You mention only 1 month. Okay. All right. So that's intra-market spread. 5 categories of risk we have already done. Basis risk. Okay. Again, many of you were very sloppy in answering this. Maybe you understand the concept, but you were quite sloppy in answering it. Okay. So it is basically it's a form of spread risk or differential risk. Basis risk exists when you have positions in 2 related commodities, but which are actually different, not identical, but they are related commodities, where you have a long position in one and a short position in another. Okay. A more explicit way, I will write that into your notes. A very technical way. Remember, basis risk in a very technical way. Okay. It exists on a hedger's book. Okay. When the underlying position, you can understand this in a very technical way. When the underlying position exists in a market which is different from the market in which the hedge position exists. Okay, and then you can just drive it home by saying that the underlying position and the hedge position always have to be opposites of each other. Okay, so if the underlying position is long, then the hedge position should be short. So the technical definition of basis risk, a very simple way to remember it, is that when the underlying position is in a market which is different from the market in which the hedge position exists. Okay, and the markets are related. Okay, and the hedge position has to be of the opposite sign. If the underlying position is plus, then the hedge position must be minus, and vice versa. Okay, this is a very simple way to explain basis risk. Okay, all right, done. Okay, any questions that you guys got? You guys did a bunch of interviews yesterday. Did you get any questions which are of a technical nature, which we have not yet covered either, from starting all the way from FM1 to whatever we have done now? Nothing which has come which has not yet been covered. Okay, no technical questions were asked. Okay, okay, fine. All right. Okay, so that we just make sure that if you go through any interviews and you hear, because last year we had a company which came and asked a lot of questions on highly technical questions on foreign exchange swaps, and those were actually more advanced questions. So that part I had not yet covered. In fact, I had not covered that part because we didn't have time that much. But then after he asked those questions, then I covered that part. So I added that to the syllabus. Okay. So based on the questions he asked. Okay. All right. So if you get any such thing, please let me know. So then we'll add it to the syllabus.
So can you share those questions separately?
Which ones? Those which were asked. Okay. I'll take up that file and share it with you. Anyway, we are going to cover it in the last in this. Now we go into futures. Okay. Once we finish this technical note. Remember, in this case, there are 3 technical notes. Okay. One is on swaps. And one is on futures. Okay, one more, and one is the general note on hedging terminology. Okay, all right. But be prepared for your technical questions in the way that I've told you. Prepare topics. Okay, so hedging might be one topic. It's a big topic, but you can just tell them some basics, concepts that you've learned: basis risk, underlying position, hedge position, all these aspects. Yes. Who has not come?
One boy has gone.
Who is the boy?
20 minutes. 20 minutes.
20 minutes. Who is this? Shushant? No. Okay. So whenever there's any trouble, we first think of Shushant. First culprit. Rahul has not yet come back. Okay. Okay, who has, is there somebody actually out for 20 minutes? Okay, we also have to put some kind of limit so that, see, that is between you guys. Now, whoever wants to go out and is not able to go out because of this guy, let him go and deal with him separately, okay? But anyway, I have to also put some kind of limit, like a 15-minute limit or something where you have to go out, you must come back within.
The person is having fragments.
We'll deal with your problem. Okay, guys, let's get back to work. Let's make sure we have everything covered here. Okay. All this stuff has been covered? Has it all been covered or not? What? Yes or no? Active, passive risk books have been covered? Yes. Yeah. Okay, so let's have some. Everybody should be, either people are looking at their phones or they're all asleep. Okay, underlying position. This we have already discussed. Okay. This logic has also been discussed. How do you figure out that? I remember now. It has been discussed. Okay. How do you figure out which way the underlying position is? Okay, whether long or short. Hedge transaction, hedge position, basis risk. I think everything here has been covered. Okay, what I have not covered is types of hedging programs. This is also an important concept to understand, okay? So, we are going to look at 2 types of hedging programs, static and dynamic, okay? Okay, guys, please read this while I rest my voice. Please read this and do some work, otherwise you'll all be looking at your mobile phones for the rest of the class. Please read what is on the note, what is on the screen. So try to understand what is the difference between a hedging. Everyone understands now what a hedging program is. You know what hedging is. So don't use, like, people tend to use words very casually. Okay? Don't use the word hedging casually. Don't throw around words without understanding the proper meaning. So hedging program is just a plan. Okay? A program means it's like a plan, okay? Or a blueprint according to which you're going to operate. So the program gives you the guidelines. It's like a plan. So it's a operating plan. So you will plan it out and then you will execute according to the plan. So read what is written there. Yes.
Sir, in interviews when we have highly technical questions, So in that case, we always have to use particular terminologies, or we can also be little bit flexible with our own language.
No. Technical questions you must be very particular about. In fact, the interviewer himself may not be particular, but you have to be particular. In industry, people use words very casually, as we will see when we discuss terms like arbitrage and all that. Okay, so you'll see when we have a discussion on the different types. So even investment banking is used here in India. It's very popular to use it casually. Okay, without understanding what it really is. So technical terms, you have to be, one of the main messages of what I'm teaching you is that you have to be extremely particular about the use of words. Okay, so do not use words casually. Many of the words you've learned have specific meanings, so you've got to use them when you mean that specific thing. Okay, so you have to be very particular. In fact, you can, sort of explain to them that I'm using this word very particularly. Okay, and this has this particular meaning. Okay, all right, guys, have you read it? Okay, so this is also something to be aware of, because you can actually run, unfortunately you'll find that when you go into industry, you will find that many listed companies also are not managing their risk in a systematic way. Okay, we've had some reports of leading companies where foreign exchange risk management is not done properly, okay, where maybe even other types of risks are not managed properly. There's no systematic plan, but that's not how hedging should be done. There should be a detailed plan, and you should operate only according to that. Okay, so in a static hedging program, understand what this means. Essentially, that means that if you are going from a position of 100% unhedged, okay, when you go from 100% unhedged to 100% hedged, the movement will be in one straight line. Even if you decide not to do 100% hedging at the beginning, if you start out by doing only 10% hedging, if you have hedged 10%, you will never lift that hedge. Okay, let's say you have a bunch of crude oil deliveries in let's say October 2019. Okay, let's say you have you have 100 million barrels, let's say, okay, or 100,000 barrels. Okay, you have 100,000 barrels. Each contract is for 1,000 barrels. Each crude oil futures contract is for 1,000 barrels. Okay, and you are going to deliver some crude oil, 100,000 barrels of crude oil in October 2019, let's say. Okay. So then what you do is you have 100,000 barrels exposure, which means in terms of contracts, you have 100 contracts, because you can't sell half a contract. You have to deal in whole contracts. Okay. So each contract is for 1,000 barrels. Your exposure is 100,000 barrels. So you have a total exposure in terms of contracts of 100 contracts. Is this clear to everyone? Okay. So let's say that you're an oil company, in which case your underlying position is what? If you're an E&P company, you know what E&P is? In the oil sector, those of you who are planning to become equity analysts, you should be already familiar with the various types of sectors that you can cover as an equity analyst, because you're not going to cover everything. Okay? Either you'll cover telecom and media, or you'll cover oil and gas. Okay? And within oil, there are various types of companies. Now, E&P are exploration and production. E&P companies do what is called exploration and production. So they don't do retail. They don't do retail selling at the petrol pump and all that. Okay, no gas stations for these guys. They do E&P, that is exploration and production. So E&P company, if you have an E&P company in crude oil, what is the underlying exposure? Long. Okay. So let's say that you have a long position, and you know that you're going to sell these barrels of crude oil, 100,000 barrels of crude oil. You're going to sell them in the month of October 2019. Okay. So your underlying position is long. So your hedge position has to be what? Short. So your hedge transactions will be what? Hedge transactions cannot be short. Hedge position can be short. Your goal is to create short hedge positions. So what will be the underlying hedge transaction and hedge position? Okay. So now you know that you have to. So this is how the logic goes. Make sure you understand the logic. Okay. So you are an E&P company. You are selling 100,000 barrels of crude oil. You're planning to sell them in the month of October 2019. So your underlying position is long, because you're an E&P company. So therefore your hedge position must be short. Okay, so your hedge transactions must be sales, not purchases. Okay, so you are going to be selling. You plan to sell, or you would need to sell 100 contracts, because each contract is for 1,000 barrels. Okay, so now the point of static hedging. If you can decide to run this hedging program. Okay. Either as a static program or a dynamic program. If you run it as a static program, that means the program guideline is that once you hedge a certain amount, you will never lift that hedge. So if you sell out of 100 contracts, if you sell 10 contracts initially, okay, at a price, let's say of 75, you get a price of 75, you're not sure whether the oil price will drop completely, you think that maybe the oil price will go up a little bit more. So you're not selling your whole position. You are selling a little bit, you sell 10 contracts at 75, let's say, okay, for October 19. Then, even if you feel that oil prices will go up a lot more, you will never lift that 10% contract position. Once you hedge it, that's for the meaning of a static hedging program. Once you hedge it, you never lift that hedge. That means that 10% of your exposure has been locked in and it's not going to be touched anymore until October 19 comes along, October 2019 comes along, and then the maturing futures contracts, you'll close out the position once the deliveries prices have been fixed. Are you guys following what I'm saying?
Yes, sir.
Everyone's following what I'm saying?
Yes, sir.
Okay. So that is how you run a static hedging program. Simply put, it means that you don't have any hedging and unhedging business. When you hedge, once a particular portion of the exposure is hedged, it is never lifted until the underlying exposure rolls off. And the underlying exposure will roll off when you finally contract with your refining, maybe your refining customer, okay? Your refining customer, let's say Reliance Petroleum, Reliance Petrochemicals, you are contracting with them. Finally, you finalize the price that we are going to sell you 100,000 barrels for October 2019 at this price. Once you've done that, then your underlying exposure is gone because you have squared the underlying position. Remember, this is not hedging. When an E&P company sells contracts to sell the 100,000 barrels of crude oil to Reliance Petrochemical, they have now squared the underlying position. They have not hedged it. They have squared the underlying position. So now is the time for you to take off the hedge position, because now the hedge position is not required anymore because the underlying position is gone. So now you are now short futures contracts. You have a outright short position in futures contracts because the underlying position has been squared.
Yes, sir.
Earlier you had a spread position. Now because you have made a sale on your underlying position, now you are left with only the hedge position, which is short. This is not acceptable because you're a hedger, you can't increase your risk. So immediately, as soon as the contract is finalized for selling the underlying position, immediately you have to lift the hedge. That means you have the short positions in the futures contracts, you have to buy them back at the market. Okay, and the way the hedge works is because maybe by the time you actually finalize the sale to your refining customer, prices have dropped all the way to $55. Okay, so those futures contracts which you sold as a hedge at $75, they will give you a $20 profit. But from the market which was at $75, by the time you're selling at the underlying position at $55, you have a $20 loss on the underlying position. Okay, because you started at where the price was 75. Okay, so now that is offset by the profit on the hedge position. Okay, are you following? Okay, so this is how it's done. So once the underlying position rolls off, remember you have to always look at your net position. Once the underlying position rolls off, you are left with a net position on the hedge book that you have to square out because you can't accept that kind of position. So this is how it is. In a static hedging program, once you put on any part of the hedge, never lift it until the end, until the underlying position rolls off. So it's clear? And in a dynamic hedging program, all that it means is you can keep on hedging and unhedging. Okay, so if you see that, let's say for instance, we have 1 minute. I'll come to, what is your question?
So can you please explain the terminology GRM gross refining margins with respect to oil industry?
Okay.
Like today discussion was going on that today Reliance is going to reveal its quarter earnings, so that how it will shape up the oil industry. And yesterday we have also had a meeting with all the oil ministers. So please explain some terminology.
Okay. So easy way. Okay. So what was I discussing earlier? I was going to just show you before you ask the question. What was I going to show you? Okay. I'll just come to your question. 1 sec. Let me just quickly finish what I was discussing. I don't know why I wanted to talk about. Okay, let's just look at this. Okay, so let's say that you were trying to hedge when you finalize. So what I was saying essentially is that obviously, as if you were at 77 when you were when you had produced you had valued your inventory at 77 when you got it when you produced the oil. But then by the time you sell it, it goes to 71. So your contract with the refiner is made at prices of 71. Okay, because the refiner will always want the current market prices. So that $6 which you lose, okay, on the underlying position, that is made up if you had fully hedged yourself at 77, you'll have a $6 profit on the hedge position. So that will offset the loss on the underlying position. So that's why whenever you hedge, if you are assuming that let's say you're always hedging 100%, okay, whenever you hedge, you have locked in your net price at the hedging price. At the price at which the hedge transaction goes through, at that price you have locked in your net realization, because the loss on the underlying will be offset by the profit on the hedge position. Okay, so in a dynamic hedging program, sorry, I was trying to illustrate the dynamic hedging program, that's why I wanted the chart. So in a dynamic hedging program, what happens is, let's say if you look at a longer time frame here, okay, say 1 minute. Let's say in a dynamic hedging program, let's say my underlying position is long. Okay, my underlying position is long, and then I have sold. Okay, I have sold at, now what is going on here? Chada and Nimish, note down penalty point. Who else is talking? I see. Okay, I'll mark that person also. I'll give them some penalties. Who is the person? Metal has gone and not come back. Okay, one sec. So let's understand this point. Okay, now has everyone understood static hedging program? Static hedging program means once you put on the hedge, you never lift it until the underlying position rolls off. Okay, at that time you lift the hedge position because there's no need for it anymore. Okay. Now in a dynamic hedging program, if my underlying position is long, okay, when the price went to $77, okay, right at the top here, the highest price point. When the price went to 77, I felt that the price was going to drop to 71, let's say. Okay, so I sold. Let's say I sold 100%. Okay, I went into a 100% hedge position. Okay, so I sold 100 contracts. Okay, my underlying position is 100,000 barrels. So I sold 100 contracts at 77. Then the price falls to, now we are discussing a dynamic hedging program. Okay, then the price falls to 71. Now I feel that the price can again rise to back to 77, 80 levels. Okay. Now what I will do is I buy back the entire 100 contract position. I'm giving you an example with a simplified example of 100% hedging and unhedging all the time. In real life, it doesn't work like this. You don't normally hedge 100%. You do it in shades. Okay. In phases. Okay. So I'm just giving you an extreme example to give you the understanding of the main idea. That once in a dynamic hedging program, because I was bearish at 77, so I sold 100 contracts. Okay, so I went fully hedged. Now the price drops to 71. Now I become bullish again because I feel now the price is going to rise and go back up above 77, head to 80. So now I quickly buy back my 100 contracts. So I've locked in this profit of $6 that goes into my hedging P&L. Okay, and then if I'm right, the price will rise and go back to 77, 80, and then again at 80 I might hedge again if I feel the price is going to fall. So in this way I can keep on hedging and unhedging and keep on trying to catch all the twists and turns in the market. Okay, this is what you do in a dynamic hedging program. Okay, so obviously I've given you a favorable example. Okay, I've given you a favorable example. Don't switch the monitor, you should switch the whole thing off. Is the PC on? The PC is not on. Okay. Right, so what you should do is, sorry, what was I saying? So in a dynamic hedging program, you can, I've given you a favorable example where I'm selling at 77 and buying back at 71. Now obviously it can go the other way as well. I could sell at 77. Okay, I could, let's say for instance what might happen is I go 100% hedged at 77. Then the price drops to 71. And I feel now that the price will, are you guys following? Everybody seems blank. Yes. Are you following? I go 100% hedged at 77 because I feel the price is now going to be down, is going to fall. Okay. It falls to 71, now I become bullish. I feel that the price will turn around and rise again above 77 and go to 80. Remember, my underlying position is long. Okay? So now what I do at 71, I'm so clever, I can see the market turning. I buy back my entire hedge position. Okay, so my hedge position is now 0. So which means my net position is the full 100,000 barrels of underlying position. So the hedge position is 0, underlying position is plus 100,000. Okay? So now let's say the oil price crashes. Now it crashes to 55, 50, etc. I am still unhedged. Okay? So this can cut both ways. When you're running a dynamic hedging program, it can cut both ways. If you try to cut time in twists and turns in the market, if it doesn't go your way, eventually I might have to give up and I might have to hedge my entire position at 50. Okay? So I have lost the entire amount on the underlying position. Okay? So I have now, if I finally hedge again at 50, okay, at $50, then I got a profit from 76 to 71, $6. But 71 to 50, that entire $21 loss on the underlying position has not been covered. So that loss will be there on the underlying position. Is this clear to everyone? Okay, so there are two ways. The reason I made the distinction is there are two ways to run a hedge program, a hedging program. But everything must be discussed in the beginning. Yes. 1 minute. How many minutes are left?
10 minutes.
Okay, go. We have to. I'll deal with middle later on. Okay. So what was I saying? Hedging. So there are reasons in the industry because people don't actually do it in a very systematic manner. But you should be aware that there are two clearly different ways you can run a hedging program. Okay. So which one is more conservative, guys? Static or dynamic? Static is more conservative. Everyone is clear? Yes. It's a much more conservative program. You can't lose money as such. Only thing is you can have opportunity losses. Okay, like let's say if I'm an ENP player and when prices have gone up, let's say in July, early 2018, you can see the prices climbing up to $60. Okay, you can see then maybe I thought, well, that's the top. So I have gone and hedged my entire production at $60. And then the price keeps on rising to $75 and all. But that's okay because I'm not out of pocket. I'm just suffering an opportunity loss because even that $60 will lock in some amount of profit for me. Okay? Typically, you will hedge when you have some amount of profit locked in. So let's say your exploration and production cost is $40 a barrel. Okay? Your exploration and production cost is $40 a barrel, and the market price is rising. It goes to 60. You see, okay, I got a nice $20 profit. Let me lock it in because I don't think prices are going any higher than this. But then the market proves you wrong and the market keeps on rising to 75. So that $60 to $75 is only an opportunity loss. It's not a cash loss. It's not a real loss as such. Okay? It's quite different. Is this clear to everyone? That you have locked in $20 of profit. You're still making $20 of profit. Instead of making $35 of profit, you're making $20 of profit. So that is, I mean, it could be much worse than that. So that is actually it's a much better situation than having a situation where you unhedged everything at 71 as being long underlying, having a long underlying position, you unhedged your exposure at 71 and then the price collapses to 55. There you're suffering a real loss, okay, of the valuation of your inventory and all that. Okay, so that has to be understood. Okay, that the static hedging program is much more conservative. So if you want to start out with in a company with a hedging program, ideally you should start with a static hedging program because in a dynamic hedging program there are other considerations also. You may lose money, so you have to also now define how much money am I willing to lose. Okay, and that will actually, we can make that into another question in the case. That how much money if you are running a dynamic hedging program, how much money should you put on the table as your risk capital, right? When you go into a casino, the correct way to gamble if you want to play games like blackjack and others, which are games of skill actually. Those are not chance games, okay? Those are games of skill. Poker and blackjack, these are games of skill, okay? So if you want to play that, but the correct way to do it, obviously you have a pre-planned approach. You assume that, okay, I'm only going to lose $25,000. So you go in with $25,000. When you lose $25,000, you walk out. Okay, that's the right way to do it. So you must identify your risk capital at the beginning, okay, of the process. Okay, so dynamic versus static hedging program. Now his question about gross refining margin. Okay, this is an easy way to understand it. Is here. Okay, So a refiner, what is a refiner doing? It takes crude oil and it produces what we call downstream products. Okay? So let's say that Reliance is producing only jet fuel. Okay? So then what happens is the refining margin, and you can see here, let's say that they are buying crude oil at market prices and selling crude oil also and selling jet fuel also at market prices. So let's say they take the entire jet crude oil inputs that they use, all of that is used to produce only jet fuel. Okay? So here do you see the refining margin? The gross refining margin is nothing but the difference between the two prices.
Yes, sir.
Output price minus your input price. Okay? So you can see this even in the case of a soybean miller. You can have a soybean crush spread, you can have a slightly more complicated formula, but to illustrate the idea of the gross refining margin, I'm giving you a simple example. Okay? Where this refinery is producing only one item. Okay? There is one output, there is jet fuel. There is only one input. Okay? Is everyone following this?
Yes, sir.
So is the gross refining margin constant? It's not constant, it's moving around. That's why they track it. Okay? That's why they track it, because it also depends on market prices. Okay? And also it depends on your operating efficiencies and all that other costs. Okay? But generally gross refining margin will more accurately capture the movement between the difference between the two market prices. Okay? So you can have imagine more complicated examples of a gross refining. Now obviously Reliance gross refining margin will not be so simple because they're not making just one product. So they make, if you look at a crude oil distillation chart, you can figure out how many other products are made from crude oil. Okay, as you distill the material, you have different kinds of products coming out at different levels of, at different temperatures. Okay, so you can produce jet fuel, gasoline, heating oil, this, that, all kinds of. So what will happen is then you have to start thinking, if you have a more complicated example of gross refining margin, you'll have to start thinking of one input in terms of crude oil. So 1 barrel of crude oil. 1 barrel of crude oil might produce 10 liters of jet fuel, 2 liters of heating oil, 3 liters of gasoline, something like that. Are you getting the feeling? Are you getting a sense of what I'm saying?
Yes.
So then you have to start breaking it up. It's nothing, the concept is the same. Output price minus input price. Okay? But now your output price is more complicated because instead of one product, you have 3 products. So you have to see 25% output is going to jet fuel. So 25% into the jet fuel price realization. Are you following what I'm saying? Okay. But the concept remains the same. Gross refining margin is nothing but the refinery's selling prices for the outputs minus the input cost. Okay. So obviously there are many costing methodologies that will affect the GRM. Okay, depending on how you do your inventory valuation. You've done all this FIFO, LIFO,
Yes.
all this stuff, right? So all that will affect the calculation of the GRM, all these costing aspects. Okay, 1 minute. Maybe it's not just 1 minute, maybe many minutes.
No, you have 3 minutes.
So 3 minutes is okay. So the things that we had not covered, and while answering the basis risk aspect of it, many of you, I guess, you guys should revise all this material. All your understanding of transactional efficiency of the hedge is not proper. Do you realize the material here is quite technical?
Yeah.
So please make sure you understand, you study it properly and understand it clearly in your head. Because when I see the answers are very sloppy. Answers are very highly unsatisfactory. Types of hedging programs. Okay, decision problems and hedging passive risk books. Okay, this is one of your questions in the case. Alright, so we have all the decision problems here. Okay, let's start with the decision problems. In the case of passive risk books, belong to hedgers or speculators? Hedgers. Okay, so Magma Resources is a hedger. Okay, do they need to decide about the asset class?
It is already mentioned.
Already mentioned means it follows from the underlying position. You don't have to decide where is my position, which asset class should I operate in, because your hedging activity is determined by your underlying position. Okay, asset class is decided. Markets. Do you need to decide about markets? Already decided by your underlying position. Okay. Instruments, do you need to decide?
Futures. Yes.
Instruments need to be actively decided, okay? Because you can choose to hedge crude oil, okay, either through futures or through swaps. In this case, we are using CFDs, which is not a wholesale instrument. But there is a choice in terms of instruments, okay? So we are going through the decision problem. Now you see why I discussed the idea of passive versus active risk books. The decision problems remain in the case of active risk books. All of them have to be actively solved. But in the case of passive risk books, okay, some of those decisions are automatically solved. Is this clear? Okay, so asset class automatically solved, markets automatically solved. What? Market is not automatically solved. Why? Okay, so yeah, in that sense I understand, but then you would still start with jet fuel, and then you would, I accept your point, okay? So there is a nuance there that in case you want to hedge, in case you want to retain some basis risk and hedge in a different case, so it's a good answer actually. So he's right that in markets you can actually add a nuance, that in case you don't have liquidity in that particular market, you may hedge in a different market, okay? Where's your bell? There's no bell. There's no alarm. Okay, time. Wait. No, I'm not setting up alarm. I'm just avoiding bringing my mobile in here. Okay, so Mitchell is the one who will get the penalty. Okay, so I'll decide his penalty. Yes, so please make sure, guys, between yourselves, when you go out, you have to come back at a reasonable time so the next person can go out. Yeah.
Like we, in a layman language, hedger reduce the risk. In hedging, we reduce the risk, and we cannot eliminate the risk, or we can eliminate also by 100% hedging. So, what is the difference between the hedger and arbitrator? Like, if the person is an arbitrator, so if he is trading in NSE and BSE at different stages, if he is trading in NSE and BSE, then he is also reducing the risk by buying at 100
No, because the difference between a hedger and an arbitrager is that in the case of a hedger, he is most likely to be sitting with the... Guys, don't switch off the lights. Don't switch off the lights. Okay. The difference between a hedger and an arbitrager is that a hedger is very likely to sit for a while with his underlying position while he decides how he's going to hedge. Okay. So in the case of a hedger, it is not necessary for him to hedge 100% of his exposure immediately. He may decide to do that, but it is not necessary, and many hedgers don't do that. Okay? So therefore, in a hedger case, you may very well see the hedger sitting on his underlying position for some time.
holding the position.
Yeah, carrying the underlying. In the case of an arbitrager, you will never see a mismatch between it buy and sells. If you are doing classic arbitrage, there cannot by definition be any mismatch in terms of timing. It must be instantaneous. That you get one guy on the phone and you're selling to him, you get another guy on the phone at the same instant, and not spontaneous, you mean simultaneous. It may not be spontaneous, it may be planned. Okay, so that's what the difference is, okay? An arbitrager will never maintain any position at all. Instantaneous, maybe for 1 millimeter, 1/100th of a microsecond, you can say he has a position, but basically for all practical purposes, no, he will never have a position.
Sir, is ECH an arbitrager?
Who?
ECH.
Exchange clearing house.
No, ECH is not an arbitrator. ECH is only a credit risk intermediary.
Okay, sir. So it does not deal with market risk, it only deals with credit risk.
Yeah, it is a credit risk intermediary. Okay, you can't say it's an arbitrator because an arbitrator would actively buy one asset and sell the same asset in a different market.
Yes, sir.
Okay, and lock in the profit. So there is no such active transaction on the part of an ECH.
How market transaction?
He doesn't do any active
Only
transactions.
initial margin.
He processes transactions.
Yes, sir.
Sir, I have a question regarding the taxonomy.
Yes.
1 second.
Yeah.
Sir, one question, sir. Sir,
We are recording all this.
Sir, this all is valid when underlying position is static.
Sorry, come again?
Sir, this all dynamic hedging and static hedging is valid until underlying position is static. We are not
Okay, guys, one sec. We are discussing. Use the mic. Those of you who are chatting, please go out. All you guys, please go out. Double A. We are still discussing technical matters. Don't chat in the classroom. Go out.
Sir, actually, Mithil just texted me that he had to go to his room. He got emergency call from him.
No. So we'll discuss that. We'll discuss that later. All you guys, get out now. Whoever is not involved in the technical discussion, get out and chat. And close the door. Shivam, close the door at the end. Yes. Use the mic.
So this called dynamic hedging and static hedging is valid until underlying position is static. It is not changing.
Yeah, the underlying position will change. So the distinction applies to the underlying position that exists at the time that you start hedging.
At the time we started.
At the time that you start hedging, you have an underlying position.
Yes, sir.
So if any change in there's any change in the underlying position, and you additionally increase your hedges in response to that, that would still not make it a dynamic hedging program.
Okay.
Because your underlying position is likely to increase only in the same direction. Like a person whose underlying position, an entity whose underlying position is long, will not end up suddenly having a change in the underlying position or go to short.
No, sir. Underlying position is not changing. It's
The magnitude of the position is increasing.
Yes, sir.
Yeah. So that's fine. In that case, if you have, let's say, if you have sold 100 contracts, you had $100,000 position. Now you find your position under the underlying position is $150,000.
Yes, sir.
Then you have to sell another 50 contracts.
Yes, sir.
You might sell another 5 contracts. But again, if you want to remain as a static, you want it to be a static hedging program, then you should never lift that 5 contract hedge.
Yes, sir.
So it will always apply to the underlying position as known at the time that you start hedging.
Sir, one question, sir.
Yeah.
Sir, if my underlying position's magnitude is 100 barrels, and now my underlying position has been squared off by 50 barrels, and I initially hedged 100 barrels. When
Yes.
my underlying position was 100,
Yeah.
I hedged 100%.
Yeah. And now
I
your
squared
underlying
my-
position has been squared to the extent of 50 barrels.
Yes, sir.
Now you should lift 50 of the hedge position.
Now, sir, will it be a dynamic hedging or it will still remain a
No,
static
it is
hedging?
still static hedging. It is static hedging
Because-
because the reason for lifting is not driven by a market view.
Yes,
The
sir.
reason for lifting is the classical reason for lifting the hedge, which is not even, you don't have any discretion.
Yes, sir.
Remember, in this case, you don't have any discretion. If you want to run a classical, strict hedging program without, playing around here and there and being casual about the rules like
Yes.
many corporates do. If you want to run a strict, classical hedging program, because your underlying position is now no longer 100 barrels.
Yes,
It
sir.
is only 50 barrels.
Yeah.
So 50 out of your 100 barrel short position in the hedge, on the hedge book.
Yes, sir.
50 positions, 50 contracts have to be lifted
Have to be.
because the underlying position has been reduced to that extent. Just close the door fully.
Or it
Yeah.
will change its what we say profile from hedges to it will become a speculative transaction.
Yeah, if you don't lift it, then it becomes then you're behaving like a speculator, which many corporates unfortunately do. They do all this stuff casually.
So-
they don't follow the strict principles.
So, but this static hedging program is done to compensate the opportunity loss.
Yeah,
Thank you, sir.
in some sense, yeah.
So that's why this becomes necessary.
This becomes
Necessary,
what becomes necessary.
like as you're saying, it doesn't depend on the market view on the main essence.
No. The difference was the example that Sahil gave. Okay, the example that Sahil was giving is that when your underlying position starts out by being 100 barrels long, and so in response to that, you put on a hedge position which is 100 barrels short. Now, out of the 100 barrels long underlying position, you square off 50 barrels of the underlying position. So your new underlying position is now only 50 barrels long, not 100 barrels long. So to the extent that you squared off your underlying position, the rationale for the hedge position no longer exists. So now in a classical and strict, classical strict hedging programs, okay, you no longer have a justification for being short 100 barrels on the hedge book. You can only justify being short 50 barrels on the hedge book. So the balance 50 that you are short, the extra 50 that you're short, you have to square from the hedge book, you have to square that 50 barrel short position. Okay, so that you are back in line in terms of if you remember the rule that we had in the case, that your net position has to be always between zero and the initial underlying position. Okay,
Yes.
clear? And that's why. So then the difference is that in this case, in a case that Sahil mentioned, okay, where you are actually your underlying position is increased, okay, and then you have to obviously increase the size of the hedge position, okay. That does not make it a static position. Or even this example that he gave actually, where your underlying position has been squared off to the extent of 50 barrels, and therefore you are lifting the 50 barrels of the hedge position.
Yes.
That is, he was saying, why would that make it a dynamic hedging program? The answer is no.
That will still be a static.
Yes, because the difference is, in the case of a dynamic hedging program, your hedging and unhedging is based on some market view, and you have some discretion whether you want to hedge or you want to hedge. It depends on, or you don't want to, whether you want to lift the hedge or you don't want to lift the hedge. It depends on your market view.
And in dynamic, we also have a net position left.
No, you don't need to have a net position left at all times. You can always hedge 100%.
That depends from situation to situation.
Yeah, you can always hedge 100%. The difference is the example that he gave, where the underlying position is squared, where the underlying position is squared to the extent of 50 barrels, and then he is lifting the 50 barrels of the hedge position.
Yes.
That is not dynamic hedging, because here he has no discretion. In this case, when the underlying position is squared off to the extent of 50 barrels, he has no discretion. Because if he, irrespective of his market view, if he's going to follow classical hedging rules, he must square that extra 50 barrels of the short position that he had on the hedge book, because the underlying position has been reduced to the extent of 50 barrels. So this is what differentiates a static program from a dynamic program. Yeah.
So dynamic program is like two side swords.
Two
side swords.
Two side shots.
Swords.
Yeah, it is like a double-edged sword. We call it a double-edged sword because you could make money or you could lose money.
Sir, I have one question regarding the taxonomy.
Okay.
Like yesterday, PM Modi had a meeting with all the oil ministers, like what the future of this will be like. So it should also come regarding the highest classification political risk, because in this crude oil market, this political risk matters a lot, because political is the main.
No, you can always make a case for putting in political risk, but normally political risk becomes much harder to sort of focus on. It becomes harder to, and many of this will get.
My view should be in the highest classification with the market risk in that risk.
That's what Goel was also saying in terms of economic risk and all that.
Yes.
But that gets reflected in the political risk, gets reflected like you see in the oil price today. In this market, there's a lot of political risk in the oil price, because you have the problems with Iran. Now you have this problem with the journalist being murdered by the Saudis, so supposedly. Okay, so all this political stuff gets reflected it gets reflected in the market risk.
As taxonomy is the science of classification, so it depends on the majorly what are the assumptions and bases we are taking in that classification.
Yeah, it depends on what your orientation is to some extent. It depends on your orientation,
like
what you want to do.
Like you gave the question regarding the risk. It was respect to the hedging.
Not really hedging. Yeah, you can say it's from a risk management perspective. This taxonomy of risk.
But in this hedging, political is also a main factor.
No. Political risk can be captured either in your market risk. Okay, the reason I've not given it as a particular category of risk is that it becomes much harder to manage. Okay. You can't really manage. Here we are talking about risks that you can more or less manage or control. You can't really control political risk. Yes. There's not much you can do about it.
But we can create substantial backup for that.
No, you can. But then a lot of it gets reflected in the market risk. And this taxonomy also reflects the fact that these are risks that you can actually actively manage.
And this crude oil market is also very much volatile, and it gets affected day in and day out from the political decision.
Yeah, so that's captured in market risk.
Okay.
It is captured in market risk. So when you are looking at market risk for crude oil, you would already capture all these political factors.
Okay.
So you're not going to do a market analysis of crude oil without thinking about what the Iran sanctions will do to the supply of oil, and therefore how it will impact the price. What the Saudis, if the Saudis carry out their threat, if there are sanctions on the Saudis and if they carry out, what that will do to the supply of oil.
Okay.
So you are bringing all that into. So it's not that the political risk is not being captured, but it is not treated as a separate category because there is not that much you can do actively to manage it. You manage things like market risk, you manage credit risk, you try to control operational risk. You don't have that much control over political risk.
But as you said, that taxonomy is a very major subject. It don't get taught in various other major schools. So why don't we have it here? Taxonomy.
No, I am teaching you taxonomy. No, that's why I teach you taxonomy.
It should be a separate subject.
No, it's actually taxonomy is very important, and there should be, but it's very difficult to find good material on it. That's why I gave you certain rules, like the high-level taxa should be mutually exclusive.
Yes.
This is a very important rule. Okay, and then you maximize the number of branches in the tree. You can go as deep as you want. Okay, but at each level you should have few categories and they should be mutually exclusive. So these are the rules that I have developed
So like
for myself.
taxonomy is required in every aspect of finance.
In every aspect of every subject. In order to understand a subject properly, you need to do a proper taxonomy. That's why it's important, but it's not taught anywhere. That's the problem.
Like for finance is further extended to many other fields. Like if we know that taxonomy, so we can plan according to that. So it should be as a separate subject.
Yeah, taxonomy.
Because it is a very much useful.
Yeah. So taxonomy it helps you a lot, and if you know how to do a good taxonomy, it helps you a lot in bringing structure to a situation.
Like it can also help in building structure of the organization and the classification, because it is a science, and science is like as per laws.
Yeah, you can do that.
So as you said that business, like in India, business are very much unstructured.
Mm-hmm.
So if we have a particular taxonomy law, then it should be better, and it would be some way.
No,
like
I didn't say that businesses are unstructured. I said business problems are unstructured.
Sorry, business problems are unstructured.
So I said business problems are unstructured. So that's what I said. Not businesses
So
are
business
unstructured.
problems.
Yeah.
So as you know that every big business is created when we have a solution to a big problem. So if we have this structured business problem, so it would be better to manage them. So that's why taxonomy law should be there.
No, there's no law of taxonomy. I'm just teaching you the principles of taxonomy. I'm just teaching you the principles of taxonomy, some certain basic principles, because in any situation that you encounter in the world of business, which is likely to be very unstructured, if you have a good sense of how to do a proper taxonomy, it will help you to bring structure.
Like we are doing hedging program in this.
Yeah.
So we have the science of taxonomy of asset classes, market. So it gets very much easy.
Yeah.
To manage the risk.
Yeah.
So that's why a particular framework, so that we can simply manage the things and we can interpret and deliver the better results.
Yeah. So that is basically why you need it helps you to bring structure to a situation.
Because the systematic approach is very much better than unsystematic.
Definitely.
So when the project is going to start?
We will start it. I'll tell you tomorrow itself. It will start in another week.
Because because our classes will get over by next week, finance and IT. And we don't have any class after 31st of October.
I'll check that. Let me check that. Okay. All right. Let me check that and I'll come back to you. Okay.
We should start the project immediately because we have very much time left, and
I'll see
there's
that.
a lot of material to cover.
Yeah.
And as you told, 10 November is the last date. 10th of November, last date of project.
Yeah. I'll just finalize all those matters and I'll come back to you guys. Okay. Hopefully I'll tell you tomorrow. Okay. Can you see if there's any way to close this, to shut down this PC? I'm not able to do it.